Welcome to this explainer where we're going to uncover exactly why the Federal Reserve can't save your mortgage and how Tokyo is actually the one pulling the strings behind the scenes. If you've been banging your head against the wall recently, just wondering why mortgage rates completely refuse to fall despite all the news coming out of Washington, well, you're definitely in the right place. We are looking at some massive macroeconomic forces today that are hiding right under our noses. Okay, let's dive right into this highly frustrating paradox. You are probably sitting there waiting for the Fed to cut rates, but housing affordability remains completely, stubbornly frozen. You watch every single press conference, right? Just hoping for that magical rate cut so you can finally afford to buy a house. The Federal Reserve talks all they want about cutting rates, yet when you actually look at the market, financial conditions still feel incredibly tight. So why is there such a massive disconnect between what we hear on the news and what we actually pay at the bank?
Well, it's because the real invisible trap isn't happening in Washington with the Fed. It's actually happening thousands of miles away in Tokyo. Literally everyone is watching the wrong central bank right now. To really grasp why your mortgage rate is stuck at such a painful level, we have to look across the Pacific to the Bank of Japan.
Section 1. Japan's Lost Decades. The Origin of the Invisible Trap.
To really unpack this mystery, we've got to rewind a bit to a brutal period of zero growth. We literally can't understand today's U.S. housing market without understanding Japan's financial history. Basically, back in 1992, Japan's massive asset bubble burst. To fight off the resulting economic stagnation and zero inflation, the Bank of Japan had to take some seriously extreme measures. Throughout the 1990s, they introduced zero interest rates. By the 2000s, things were still so incredibly sluggish that they pushed rates below zero. And then, in the 2010s, they implemented a truly desperate, totally unprecedented monetary policy. They created something called yield curve control. They effectively superglued their long-term bond yields directly to the floor, which basically trapped massive Japanese pension funds into earning a 0% return domestically. Just imagine for a second you manage a massive Japanese life insurance company. You have $1 billion to invest, but your domestic bonds literally pay out nothing. You have to make money somehow, right? What do you do when your own country pays you absolutely zero?
Section 2. The yen carry trade. The world's ATM.
Desperate for a return on their billions, Japanese investors went on a massive global shopping spree by leaning into a brilliantly simple math equation, the yen carry trade. Here's how it worked. Step 1, borrow yen for basically free. Step 2, convert that yen into US dollars. Step 3, buy up US treasuries yielding a nice, safe 4%. Step 4, pocket the difference. It was a total no-brainer. Japan essentially transformed into a provider of trillions in global liquidity, creating an infinite money glitch that exploded into a multi-decade global shopping spree. Because of this massive strategy, Japan quietly became the largest foreign holder of U.S. treasuries and mortgage-backed securities, effectively acting as the duct tape of the entire global financial system. They essentially became the world's ATM. For 30 years, this cheap borrowing trade provided trillions in liquidity, quietly keeping the entire system running super smoothly and keeping global borrowing costs incredibly low.
Section 3. The Free Money Glitch Breaks. The 2024 Plot Twist.
But then, in 2024, that financial duct tape finally started to peel, and the free money glitch just broke. The music simply stopped playing. For the first time in 17 massive years, the Bank of Japan ended yield curve control and actually raised interest rates. Think about the sheer magnitude of that for a second. For nearly 2 decades, the financial world treated Japan as the ultimate, infinite source of free money. And suddenly, practically out of nowhere, the tap was turned off. Virtually overnight, the math totally inverted. The strategy that had worked flawlessly for 30 years was suddenly a losing trade. Borrowing in yen was no longer free, and the cost to hedge currency risk spiked dramatically. Because it became way too expensive to hedge, all of that money that had been quietly propping up the U.S. financial system started rushing rapidly back to Japan.
Section 4. The U.S. Supply Problem. Who buys the debt?
Now, you might be wondering, how does a Japanese pension fund pulling its money back actually kill your dream of finally buying a house? Well, the secret that most people completely miss is that your 30-year mortgage isn't actually tied to the short-term overnight rates that Jerome Powell and the Fed control. Actually, scratch that. It's not just that it isn't tied to it, it's strictly anchored to long-term yields, like the 10-year Treasury. And those long-term yields are completely out of the Fed's hands. They are driven purely by open market supply and demand. See, the United States is constantly issuing massive new debt to fund trillion-dollar deficits. The government honestly needs this money just to keep the lights on in the economy. For decades, Japan was our most consistent price-insensitive buyer, happily absorbing all that new debt. But with Japan stepping back, it creates a terrifying supply and demand problem. Who on earth is going to step in to buy all that debt?
It all boils down to basic economics. Without Japanese demand absorbing our debt, the U.S. government has to offer higher returns to attract new global buyers. That naturally pushes the 10-year Treasury yield up. And because your mortgage rate strictly tracks those long-term yields, an elevated Treasury yield pretty much guarantees an elevated mortgage rate. It's a direct chain reaction.
Section 5. Your mortgage rate reality, the true cost of global liquidity. Mainstream financial media often ignores this entirely. Why? Because global liquidity is complicated, it's nuanced, and frankly, it doesn't get easy clicks. Everyone wants to talk about AI or domestic inflation, but this right here is the real machinery of the financial world. The absolutely crucial takeaway is that no matter what Jerome Powell says on TV, if foreign demand for our debt dies, your dream of a 3% mortgage is simply not coming back. Housing affordability will stay strained, the refinancing market will stay muted, and the entire real estate market will remain frustratingly frozen, regardless of any short-term rate cuts in Washington.
Understanding global liquidity is really the only way to actually know where real estate is heading next. So my question to you is, are you ready to look past the Federal Reserve and start watching the real threats hiding in plain sight? Remember, always look at the full picture, and don't let yourself get distracted by the loudest headlines. Catch you next time.